When I first started trading, indicators completely blew my mind. Suddenly, I wasn't just staring at random candles anymore, I was reading them. Every moving average crossover, every RSI divergence, every Bollinger Band squeeze, it all started to tell a story. And that's exactly what we're diving into today: how to use indicators effectively, not as magic tools, but as instruments that help you understand market behavior in a structured, disciplined way. Let's be honest, the market can feel like noise. It moves up, down, sideways, and then suddenly breaks out when you least expect it. That's why indicators exist, to bring clarity to the chaos. They help you interpret data objectively and strip away some of the emotion. And make smarter, evidence-based decisions. But, and this is important, no indicator is perfect. They're tools, not oracles. If you've ever read about technical analysis, you've probably come across the two main types of indicators: trend indicators and oscillators. Trend indicators show you where the market is generally heading, up or down, while oscillators help you understand how strong that trend is, and whether it's reaching exhaustion. Together, they paint a more complete picture. Let's start with one of the simplest but most powerful tools out there: the moving average. It's literally the backbone of technical trading. What it does is smooth out the price action, so instead of reacting to every tiny fluctuation, you see the bigger picture. There are two main types: the simple moving average and the exponential moving average. The simple version takes the average of closing prices over a set period, while the exponential one gives more weight to recent prices, so it reacts faster to change. Here's the thing though, moving averages lag behind price. They don't predict, they confirm. That means if you're the kind of trader who jumps into every little move, they'll frustrate you. But if you use them strategically, say, watching for crossovers like the Golden Cross, when the 50-day SMA crosses above the 200-day, or the Death Cross, the opposite, they can become powerful confirmation signals. Then comes the RSI, the Relative Strength Index. This one's an oscillator, and it measures momentum, basically, how fast and strong price movements are. The RSI moves between 0 and 100. When it's above 70, the market is considered overbought. When it's below 30, it's oversold. Sounds simple enough, right? But here's the nuance: in a strong uptrend, the RSI can stay above 70 for weeks, and you'll miss great opportunities if you assume it must drop immediately. That's why I always tell traders, don't trade RSI signals in isolation. Context is everything. When you combine RSI with something like MACD, the moving average convergence divergence, the magic starts to happen. The MACD is like a momentum meter layered on top of a trend indicator. It shows the relationship between two EMAs, typically the 12 and the 26. You've got the MACD line, the signal line, and the histogram. When the MACD line crosses above the signal line, that's your potential buy signal. When it crosses below, that's your potential sell. But again, these signals mean nothing without confirmation from price structure and other indicators. And then, of course, we have Bollinger Bands, one of my personal favorites. They're brilliant for understanding volatility. Picture three lines. The middle one is a simple moving average, and the upper and lower bands are standard deviations from that average. When the bands squeeze together, volatility is low, and the market is coiling up for a potential breakout. When they widen, volatility is high, and the move is already in motion. The upper band often signals overbought conditions, and the lower one oversold, but, like with RSI, those signals only matter in context. Now, let me share a story, a case study that really shows how these indicators can come together to form a solid trading plan. Jane, an experienced trader, wanted to refine her euro to US dollar strategy. She decided to combine four indicators: moving averages, RSI, MACD, and Bollinger Bands. Instead of using them all at once in a chaotic mix, she assigned each a clear purpose. The moving averages gave her the trend direction. The RSI showed her momentum and potential reversals. The MACD confirmed the strength of that trend. And the Bollinger Bands helped her identify volatility and possible turning points, One day, she noticed that the 50-day moving average had just crossed above the 200-day, that's the golden cross. A bullish signal. But she didn't rush in. She checked the RSI, it was sitting around 25, meaning the pair was oversold and might be ready to bounce. Then she looked at the MACD. The MACD line had just crossed above the signal line, confirming bullish momentum. Finally, she saw price touching the lower Bollinger Band, hinting that the market was stretched to the downside. Everything lined up. Jane bought euro to US dollar at 1.12. She placed her stop just below the last support at 1.115 and aimed for the upper Bollinger Band around 1.13. Over the next few days, price climbed steadily. When it finally hit her target, she closed the trade with a 100 pip profit. Fast forward a few weeks later, the opposite setup appeared. This time, the 50-day SMA crossed below the 200-day, a death cross. The RSI climbed to 75, signaling overbought conditions. The MACD flipped bearish, and the price touched the upper Bollinger Band. Jane sold at 1.14, set her stop at 1.145, and targeted 1.13. Again, textbook. The trade played out perfectly. The result? 2 disciplined trades, each planned using the same structured approach, no guesswork, no emotion, just process. What I love about Jane's example is that she didn't rely on a single indicator. She built a system, one where each tool had a purpose and confirmed the others. That's the essence of smart trading. As John Bollinger himself once said, indicators are not holy grails, they're guidelines. And that's exactly how you need to think of them. They are decision support tools, not decision makers. From my own experience, I'll tell you, the biggest mistake traders make with indicators is either using too many or using them blindly. Indicators should simplify your analysis, not clutter it. Choose a few that complement your strategy and master them. I've used the same combination for years, adjusting parameters but keeping the logic consistent, because consistency beats novelty every single time. The key takeaway from today's tip is this: indicators help you trade with structure. They allow you to define entry and exit rules, manage risk systematically, and filter out emotional decisions. But they only work if you understand their limitations. A lagging indicator like the SMA won't catch tops or bottoms, but it'll keep you aligned with the trend. An oscillator like RSI might flash oversold too soon, but it'll help you spot exhaustion before others see it. That's your edge. So, as you go back to your charts, I want you to think about this: are you using indicators as confirmation tools, or are you using them as a crutch? Because the difference defines whether you're trading with clarity or with confusion. This was tip number 12, use indicators. Before we wrap up, here's my question for you, and I really want to hear your thoughts in the comments. If you could only trade using 2 indicators for the rest of your career, which would you choose, and why? Drop your answer below, and let's see which tools the trading community trusts the most. Until next time, trade smart, trade systematic, and remember, discipline is your best indicator.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.